First, the mortgage bubble burst in the United States, having been fueled by easy and cheap lending, to many of whom who could not afford to pay their mortgages back. This wasn't viewed as a problem at the time, because all these mortgages had been packaged into mortgage-backed securities. These are basically big baskets of mortgages. It's not a big deal when one fails, because you still have many mortgages paying you the return on investment. Also, when someone fails to pay, the creditors would repossess the house and sell it. House prices were always going up, so the value of the house by this point was often worth more than the mortgage. This isn't too bad until many of the borrowers could not pay their mortgages back, and this is exactly what happened. Then property markets started to fall, which meant people's houses were worth less than their mortgages, making them subprime. Banks such as Lehman Brothers were heavily involved in mortgage debt. The value of these mortgage-backed securities dropped rapidly. This eventually forced Lehman Brothers to file for bankruptcy. The crisis in the subprime mortgage market was now taking down banks. With this, and with the problems in the property market, a full-blown banking crisis was underway. The crisis, without the right intervention, could lead to the collapse of the global financial system. The consequence of the crisis led to the collapse of the stock markets. Housing markets around the world suffered. Consumer wealth declined. There was a downturn in economic activity. We saw the failure and decline of business and a reduction in tax revenue for governments. By the end of 2009, Europe was embroiled in a debt crisis that provided an immediate threat to the governments of Greece, Cyprus, Portugal, Spain, and Ireland, as they could not pay off or refinance their debts. Central banks and governments around the world responded by expanding their money supplies. The United States Federal Reserve did this by lending out newly created money with the borrower's collateral being mortgage-backed securities. Central banks bought government debt on the secondary markets, keeping interest rates low. They also lowered their own interest rates for borrowers. Governments borrowed vast amounts of money to keep their spending at current levels, and also financed projects on debt. Governments also purchased newly issued preferred stocks in major banks to inject liquidity into the banking system. This provided the banks with the money to service their debts and continue lending into the real economy. The point here is not to say whether this is right or wrong, but rather to show that the solution to a crisis founded on debt led to a lot of additional debt being created on top of existing debt. The problem tends to develop something like this. When the public or businesses can't pay their debts, then the banks lose inflows of money, and they can't pay their debts. At this point, the governments come in and take out debt to help the banks pay off their debts. Unless the governments don't have any money and no one wants to lend to them. In the case of Greece, their banks got bailed out by other countries. Now there is more debt than there ever was before, with global debt levels at an all-time high of $237 trillion, over 40% higher than 10 years ago. The United States federal government, for example, now has $20 trillion in debt, and this has been growing ever since the creation of the Federal Reserve in 1913. The debt to GDP ratio in the United States has now reached the level it was after World War II. Also, the Fed expanded their balance sheet from $858 billion on the 1st of August to over $4 trillion. This was mostly done by buying treasury securities and mortgage-backed securities. The overall public and private debt in the United States has dropped since its peak of 296% of GDP in 2008, but this is partly as a result of foreclosures and increased rates of household savings. As the solution to the debt crisis was to add more debt, the governments are now in more debt than ever before. No one knows what exactly will happen, as there are so many variables, but it is possible for the next financial crisis to be bigger than the one in 2007 and 2008. Thank you for watching. Please like and subscribe by clicking the red button below. We will bring you more videos on philosophy, economics, and technology.